Now, you may have heard of our next guest on the Property Summit. We've got a fantastic speaker now for you. We've got Mark Barrett from Property Tax Advice and Riverview Portfolio. And as well as being the lead accountant for the specialist firm Property Tax Advice Limited, Mark is also a residential and a commercial landlord. So the almost constant question from property entrepreneurs is, how should I structure my business? And the answer is dependent on you and your objectives and the strategies that you choose and the timetable and so much more. And each plan is got to be personal to you. So in this presentation, Mark is here to set the scene for you and to show you how you can begin to work through making that decision. So Mark, thank you so much for joining us on the summit.
My pleasure.
So over to you, Mark.
Okay, well, thank you very much. Hopefully this all works and you can hear me fine. So thank you, Rick, for that introduction. As you know, my name is Mark Barrett. So let's crack on. So first of all, I thought I'd give you a quick introduction to who we are. We are a firm of accountants. We have a specialization in property tax, as you've heard. I'm a residential commercial landlord. I was a property developer up until 2007. Do you remember that, how bad it was? So in November 2007, I ceased my work as a property developer. In fact, I came out of the stock market as well and sold off a lot of property and went to cash. Bit of a bad feeling about what was going to happen in 7 and 8. And this time I was right. We're based in the central and southwest of England, Birmingham and London, but I've literally got clients throughout the world, and I have a great pleasure to look after a lot of overseas clients. We work with a lot of larger groups, a lot of smaller firms, there's hundreds and hundreds of smaller firms, and we're delighted about that. As a company, there's 39 of us. As of tomorrow, there'll be 40, so the 40th one starts tomorrow. That's quite nice. As well as Property Tax Advice, we've got Riverview Portfolio, which is our main accountancy firm, which looks after a lot of other people, particularly contractors and the building trades, as well as retail and manufacturing. So we can look after a lot of people. So that's us. Now, this is one of the most important slides I'm going to be dealing with today. Please pay attention to it. It's your health and stroke wealth warning. This presentation is not professional advice. Everything that we're going to be talking about would be dependent solely upon your circumstances. So you must not take action or refrain from taking action based on anything I've said today. This is a general introduction. Take professional advice based on your personal circumstances. Talk to your accountant if hopefully your accountant is a good property accountant. If not, there's lots of us around, or indeed you can come and talk to my firm. So, today's topics. For those of you who know me, I talk a lot. That's because I try to train people rather than just tell people what the answers are. So we're going to go into some detail here, and I'm just going to cover 4 topics. The first one I think might surprise you. The first topic I'm going to deal with is the moral and ethical standards of your advisors. When you listen to advice, I think it's always worthwhile understanding the standards that your advisors are working to, and you've got to make sure they match to your standards and your desired position for your business. You are solely responsible for your business, so make sure your advisors are on the same wavelength as you. We're going to be talking about GAAR and intent. I don't know how many of you listening to this would have heard about GAAR, but hopefully by the end of my presentation you'll know a bit more. Changing tax landscape and the attitudes I think you need to adopt for success. Obviously there's been a lot of changes on tax. We'll be going through some of them. And the main substance of this presentation will be structuring your business for tax. So let's go on to the moral and ethical standards. I know it's a bit of a gruesome picture, isn't it, folks? I use a lot of analogies in my presentation, so hopefully you can cope with that. So now you're going to have my wildebeest analogy. I think it's very important, it doesn't matter who you're listening to, and that includes me, that you've got to make sure that the moral and ethical standards that your advisors, people you're listening to, adopt matches yours. The only standard that matters is yours, not theirs. So I use this analogy now to describe to you the standards that we will be operating to and how I'll be presenting today. So let's go back to the wildebeest. Some of you will have been fortunate enough to have seen these in real life. I haven't seen them on TV. Hundreds of thousands of wildebeest go charging across the savannah. Lions are all around them. Now, I think that the wildebeest that's in the middle of the pack, he's just going along with everyone else. He's fine. I don't think there's a lot of chance that the lions are going to eat that one. Where I think there is a problem is if there's a wildebeest right at the back, they're a bit late. So they haven't filed their tax returns on time. They're a bit late with their compliance activity. They're always just too late. They haven't paid their taxes, whatever it is. I think the lions will eat that one. I think HMRC will have a word. Just as important, there is the wildebeest that's right on the edge of the pack. They're taking some risks. It might be that they've listened to advisors who've said, don't worry about telling your mortgage company that you've changed the use of your property. It'll be fine. They will never find out. I think that's a bit of a risk. And I think the lions will eat that one. So if you're of a mindset that you want to delay matters, you want to take, particularly if you want to take those sort of risks where you're perhaps not doing things properly, my presentation will have no value to you. What I will be trying to do is get you into the middle of the pack. And that does mean you're going to pay tax. I don't think tax is a bad thing. We all want doctors and nurses, policemen, army. And I think it's right that we pay tax, but we shouldn't pay a penny more than we have to. So the moral and ethical standard that I will operate to is there'll be no silly schemes. There's nothing weird on the edges here. It's just basic level looking after you. Let's make some money and don't pay too much tax. So there's the moral and ethical standards that I'll be presenting from today. The next topic is GAAR. I don't know how many of you have heard of GAAR. The general point that I would make is that for decades, governments have written legislation which is frankly so badly written that accountants have danced their way through little holes that they can find, and you've heard about it over the years, and you may be part of the campaigning groups to get people to pay their appropriate taxes from the PLC level. What we've had, I think, in the last decade, government has been writing legislation, however unpleasant that legislation is, and we've all suffered a little bit from some of that legislation, but they've written it in a good manner. They've been quite competent at writing their legislation. There aren't that many holes to dance through. But what they've also done is they've also created this GAAR legislation, the General Anti-Abuse Regulation. And this is a bit of catch-all legislation. It's fairly typical of what the government's been doing for a while now. They have this catch-all legislation that says if we don't catch you with everything else, we can use this one. You'll see on the screen the quotes which I've taken straight from HMRC site. It's their approach to managing the risk of tax avoidance. Now, all of that actually doesn't sound that bad, but let's put that into context. When this regulation was first being drafted, it was actually called the General Anti-Avoidance Regulation. And it's only when it came towards being finalized that it changed the word from avoidance to abuse. If you try to avoid tax by use of contrived methods, there is a potential for HMRC to use the GAAR regulation to bring you back into taxation and punish you for the actions you've taken. So what does this mean for you? You're a property entrepreneur. What does it mean? Well, I think it really means you need to be very clear on your intent. I think you need to be very careful about what you say and who you say it to. So I don't know how many of you are on Facebook. I don't know how many of you have connected to me, and if you haven't, then you're welcome to do so. There are some silly things being said on there. So people are actually going on to a forum with, let's assume it's Rick's HMO forum, 10,000 people, nearly 10,000 people now, 9,000 I think. And they might say, well, they're trying to avoid a tax, and if they're going to do this and that, and they're not going to tell the taxman, do you think we can get away with it? And they're really standing there with a foghorn shouting that they're going to try and avoid some tax. Be careful of your intent. Be careful what you say. Be careful who you say it to. Be careful what you say on social media. Now, the word intent is important, so now I'm going to just focus for a moment on intent. Evidence of intent is very important, and I'm going to be showing you that now. One of the things I want to bring to your mind is that there have been changes. I've said that they've written legislation in a competent manner. One of the things they've done is they've changed phraseology from the intent to an intent. Now, I'm sure you've grasped very quickly what that means. If there were potentially two benefits you might get from a property purchase, so let's say you've bought a property, you've announced yourself on social media, the usual sort of ubiquitous picture of the hand holding the keys. We've all seen them. Brilliant property, number 5 in the portfolio, just going to refurb it, going to rent it out for a couple of months, and then I'm going to flog it because the new hospital's opening or something like that. What this person has said is that they have more than one intent. They're going to intend to buy it, refurb it, that's fine. And then they're going to rent it out for a very short while. Then they intend to sell it because they're going to make a killing on the capital value. It used to be that if you had one intent, the intent was to rent it out. Now it is an intent. Well, now it's an intent to rent it out and to make a capital gain. Therefore, because you've intended right from the outset to make a capital gain, that's now called trading. It's not subject to capital gains tax, it's subject to income tax. So just simply a change of a word from the to an has quite a dramatic effect. So it's important you get things evidenced. So how do you evidence? If you're using a company as your investment vehicle, there'll be a task which you have to do, which is called the company secretarial work. It's where you do board minutes. I know that sounds really silly. You've got a company, it might be owned by a husband and wife, but of course you don't need to write down what you said. I'm afraid you do, because actually there's 3 people in that relationship. There's a husband and wife and a company, and you need to write down what the decisions were and why. Record it, put it into company secretarial. Now, if you imagine yourself in the situation where you're having to face the taxman and he's asked you a question and you present some minutes and they're dated 3 or 4 years ago, taxman immediately says, "Oh, that was a very interesting writing last night, did you?" So how do you make sure that you have timed and dated correspondence? Well, perhaps you write your minutes and share them with your accountant, solicitor, broker, business partner, somebody. So now you've got documented, timed and dated evidence that a document was written contemporaneously with decisions that you make, not retrospective. However, please be very careful on this one. Watch what you say. I'm afraid as a firm of accountants, we get some rather ridiculous emails where people might send me an email. Thankfully, not usually as clients. I was doing that as prospective clients, and they're really quite silly, some of them, who are saying, "I'm going to do this, but I want to see if I can not pay the tax man. So what I was going to do is I'm going to say I was doing this, I'm going to say I was doing that, but it's not real." And actually what this person's doing is not talking about avoidance of tax, which again the GAAR will stop, but they're actually planning on evasion and sharing it with a professional. Not smart. So if you're worried about what should you say, what can you do about it? Well, perhaps get your advisors to write the emails and minutes of meetings and send them to you. Then your accountant, let's say, will have taken a little bit more time and effort to make sure that they've only written down the accurate detail and not some of the perhaps inappropriate musings that might have happened in an idle conversation. So what we've just covered there very quickly was GAAR and intent and evidence of intent. All important. Hopefully you never need any piece of evidence of intent. But if you do, you'll be very pleased you had it. Okay, so I'm going to go on to the third topic. It's the changing tax landscape. I thought I'd start with this lovely picture in the top right-hand corner there of everybody's favourite Chancellor. Don't we all love him, and aren't we pleased he's gone? There's been a lot of changes. There's been so many changes that in this webinar, there's just no possibility of me covering every single one of them. That would be hours and hours. But I'm just going to list through them. If any of these you're not aware of, and or you hadn't realised they've disappeared, go and take advice that's personal to you. So the one everyone seems to talk about is clause 24, which is the restriction of relief for interest charges. If you've got properties in your own name, interest will now be relieved at 20%. We're going through the phasing in period at the moment, but interest will only be relieved at 20%. So even if you're a 40% taxpayer, or even if clause 24 shoves you up into the 40% tax bracket, you'll only get tax relief at 20%. Everyone's worried about that one. The one that doesn't get talked about often enough, and actually I think this has an even more dramatic effect on so many people, was the withdrawal of the furnished property relief. So when you're letting out your HMOs, BTLs, you would have furnished it sufficiently for occupation, whether that's what the residents finally used in the end or not. And it just meant you could take 10% of your turnover and take it outside of taxation. And that was quite a big effect. Another one we talk about quite regularly, of course, is the stamp duty change. It's very unpleasant. I don't think it's quite as bad as people are talking about. At the end of the day, yes, the government has just put their hand in your pocket for 3% of your capital value on a property you're buying. But if your deal doesn't stack up because of a 3% increase in stamp duty, then your deal was never going to work in the first place. If it was that marginal that 3% killed it. I do agree, having someone steal, it feels like stealing, doesn't it? 3% of your capital value just feels awful. But we'll manage, we'll get on with our business, and we'll make a profit. There's been a reduction in capital gains tax rates in the country, which is wonderful, but of course they don't apply to us as property businesses. It does feel as if we're being targeted a bit, doesn't it? The government has been focusing on developers who are claiming capital gains tax rather than paying income tax. I've already referred to this already, and in fact, let me just say it again. What's your intent? This focuses on those buying for capital growth. So if you cannot justify why a property is in your property portfolio, and the only justification for it is because you've been making capital growth, now this then you'll end up with potentially some tax liability there, potentially under income tax. Now this, I think, was focused particularly on London. We know that the growth of capital values in London has been horrendous or tremendous. I don't know, depends whether you're buying or selling, I suppose. For some years now, of course, London prices are struggling. We've also got other changes that are happening on capital gains tax. Now, one of these is what's called, we've already dealt with something called GAAR, which is a general anti-abuse regulation. Now, this one is a TAR, a targeted anti-abuse regulation. So this obviously just means it's targeted at one particular tax. And this one is on entrepreneurs relief. Now, entrepreneurs relief is fantastic. It's for perhaps the developers who might be listening in today, rather than the people owning property portfolios. And what we used to do, and I'm afraid I was guilty of doing exactly the same thing because it was part of the law, I could do it, is you can open a company, develop some properties, keep the profit in there, close the company down, take the money out under entrepreneurs relief. And what that meant was in the first £10 million that you made in your lifetime, you only paid 10% tax on. So who wouldn't mind 10 million at 10% tax? It was very good. We used it, I did as well, but it's gone now, sorry. We've also seen the Prudential Regulation Authority has been toughening up the affordability tests. I hope your broker will be telling you about this. Portfolio landlords, the requirements now have business plans. I'll be talking about that as well in a moment. There is this thing for the annual tax on enveloped dwellings, ATED. They've had a new lower band, so that's brought many more landlords into having the requirement to file an ATED return. Usually we're not paying a lot of tax on it. It's not really aimed at us, but it is some more compliance activity, more effort we have to put in. Last one that I'm going to deal with right now is there's been a significant change to the taxation if you're using overseas investors as JV partnering, for example, or just loan investors into property developments in the UK. Don't see very many people talking about this, which worries me, because it tends to indicate, therefore, that people are not aware of the rules. If you are using overseas investors to invest or to loan money to your property business, please take some advice. This has serious teeth, and it will hurt if they bite you. So, as I say, it does feel as if we've been targeted a bit, doesn't it? Does it make us despondent? Well, it makes us slightly annoyed, that's for sure. But the reality is, the educated property entrepreneur, we do still prosper. I'm going to be talking in a few moments about the attitudes I think you need to adopt. And not to do name dropping, when all of these rules came in, I dined with a minister and asked him, what's the point of what you're trying to do here? Why are you hurting all my property businesses? The response was very short. That's the problem, is they're not behaving like businesses, and we want them to. And that was the response. So the educated property entrepreneur will prosper. Invest in your future. Again, I see lots of comments about how you shouldn't be taking education. I think that's wrong. I think you should take education. And well done for spending your time and listening to Rick Gannon's Property Summit. But the fact that I'm speaking on here and I'm trying to protect my reputation, you know full well that if I'm here, it means I've got only good things I can say about Rick, and I've listened to him for many, many, many hours. A great trainer, and very reasonable with pricing, etc. So 2 overriding attitudes, and I think you need to adhere to these. So please excuse me now, I'm going to be a little dictatorial, but let's see if you can bear with this. I think there are 2 fundamental attitudes. One I think we should start with is, I think you should behave sensibly. If you're looking at all the changes that the government's made, and I told you what Sajid Javid said, you should behave like a business. You're creating a business. So everyone is trying to get you to be sensible about what's your loan to value, what's your risk analysis, can you pay back your mortgages, can you afford it? And obviously now you've even got to factor in, can you afford to pay your tax bills? Now you're a portfolio landlord if you get 4 or more properties. There's constant. And I know everyone, all my clients all moan about this, but actually, I don't think it's that wrong. Why would you not conduct yourself sensibly to make sure your loans are affordable? Why won't you manage your risk? Why are you not checking for negative equity? I think if you're going to do this, I think you should do it right. So behave sensibly. You're going to be a business. Behave like a business. Do it properly. Do it professionally. Second, I think it's important that you develop your strategy plan right from the outset. Of course, I run an accountancy practice, and people come to me and they spend money with me, and I wouldn't suggest for a moment we're cheap. If I ever thought I was cheap, I'd put the prices up. Too many people come to me and they've done reasonably well, or in some instances very well and better than me with their portfolios, but they've gone completely the wrong direction. They didn't think about what their objectives were. They didn't think of their destination. So they get to an age, they've got a stonking portfolio, but it just isn't doing what they want, and they haven't planned. So why wouldn't you behave like a business and create a business plan? Very simple. Why are you doing it? When are you going to do it? What are you going to do? How? Who with? JV partners, maybe bringing your family in, maybe worrying about inheritance tax with children. So these things need to be thought about from the outset. Develop a proper business plan like a proper business. Write the plan down. Make sure it focuses on what you want to achieve. I always ask my clients, I can't make anyone do anything. I always ask my clients to sign their plan. Tell me that you own it. Yes, of course you can change it. Now, put that in context. I'm grey-haired now. I have a business plan for my business, and I review it and rewrite it every single year. And I share it with my supporters. I think you should do the same. Okay, the next picture is a picture that I wouldn't mind the idea that people actually printed off from this webinar and stick it above your desk and think about it every day. That's what I've just been talking about. Think about your why. What are your horizons? What's your objectives? Work out what your individual property strategies are and put them into your plan. This, I think, is one of the largest and most frequent problems I have to deal with where people have not dealt with this. So having just invited you to print off this page, and only this page, please, from this webinar, what I will say to you is, please don't do what someone else has done and printed off the whole webinar. Went to a structure page that I'm going to show you in a moment, and then come back to me and say, this is my business plan because Mark Barrett told me. No, I didn't. This is the only page I think you should print off and pin above your desk. Okay? So let's get to the substance of this. We're going to structure your property business for tax. Now, to be honest, I'm going to be focusing on companies today. But what I do not want anyone to assume is that companies are the only answer. I'm seeing it every day on the Facebook forums and in networking, property networking meetings. So let's put this sensibly back on the table. Why can't you just buy and hold your portfolio in your own name? It is definitely the simplest form of business. You just get on with it. There's less regulation than having a company. Your mortgages will be cheaper. Certainly the first few mortgages, it might well be as you get to be a portfolio landlord, the mortgages stabilize and they're about the same as in a company. You might have higher tax. Yes, I agree. But the cash is in your pocket. It's your money. Clause 24 will apply. Yeah, I'm sorry, but there's nothing we can do about that. There are some benefits. You notice I've used the phrase here, costs are to be wholly and necessarily incurred. Well, that's a damn sight better than in a company, which are that costs have to be wholly, necessarily, and exclusively incurred. So now you have to think back, what is the purpose of your property business? And I will be touching on this again in a moment. About 30% of all the people that phone me and say, should I form a company, or even Mark, form a company for me, I actually chat with them, and the end result is, no, a company's not the right thing for you. So don't assume that everybody on the forums, just because they have a company, that you should as well. So that's a big one, please, folks. You can use trusts. These are coming under regular scrutiny now by HMRC. We have seen some changes to trust legislation. I think we're going to see some more. There isn't anything I can publish today that's going to say it's going to change, but I think it's under scrutiny. LLPs, again, I know that some people are advocating them. Again, this is coming under scrutiny. If anybody wants to talk to me about trusts or LLPs, I'll be absolutely delighted to have a conversation with you, but I just don't have the time within this webinar to deal with this. So I'm going to go on to the next topic, which of course is the limited company. And that will be the focus of the rest of this presentation. So let me emphasize it one more time. If that isn't appropriate for you, if you want to consider some of the other structures, talk to your accountant, talk to me. So let's have a look at companies. But again, I'm going to just go back and reassure you and me, should you use a company for your property investments? An important page, people. I assume that because you're listening to the broadcast, you want to build a property portfolio. It might well be that you're into property developments. Now, most of my presentation is referring to portfolio. Developments is absolutely fine. Again, don't take specific advice, but yes, companies apply still here. If you're trying to build a portfolio, I assume that means that you're going to be making profits. You should be taking some money out of your business. I always encourage my clients to try and take at least a holiday on their business every year, just to give them a prize every year for success. But there will be a surplus of profits that you want to reinvest into your business. And companies are very good at that because you pay tax at 19%. Therefore, you can now reinvest 81% of your profits. The government's announced that we're going to get lower tax rates. Well, that's great. We should never do things for the short term, no. Goodness knows what would happen if Jeremy Corbyn became Prime Minister and we've got a Trotskyite government. But for now, 81% could be reinvested into your portfolio. But what if that statement's wrong? What if actually you intend to spend your profits on your daily needs, your food, your clothes, etc.? Then a company probably isn't right for you. So I'm going to do a little bit of maths with you. So a company will currently pay 19% corporation tax as profits. Let's imagine that you've got significant lumps of money in here. This is now, I'm going to be using top rates levels of tax. So I am talking about top levels of tax now. And if you distribute all the profits, in addition to the company paying tax, then you'll have to pay income tax when you take the money out of the company. So you've had double taxation. So you could end up with 19% corporation tax, then 38.1% tax on your dividends, top slice of 50%. It actually says over 50% now, it isn't, it's 50%. But you're good at POA, it's going to be very expensive. So if you're going to take out everything from the company, and that is your long-term ambition, fantastic. Perhaps the company isn't right for you. Obviously, I've offered you a black and white scenario here. Are you going to leave some profits in or take some profits out? There is the situation where you say, well, currently you're going to leave the profits in because you've got a good job and you don't want to take any more cash out, but eventually you want the company to look after you. That works. I don't have a problem with that. Again, take specific advice relevant to your circumstances, but the principle of using a company long-term for you to live on, perhaps as also to create some legacy for children or whatever, does work. So I'm quite content that talking about a company today is probably going to be useful to you. Okay, so now we're going to go on to what type of company you need. Now you can see that I've used the word helicopter view. I don't know whether you all know what that means, so I'll explain it. Helicopter view, let me explain that one for you. Let's just imagine you're walking out to your helicopter and you can see every blade of grass under your feet. You get in the helicopter, starts to go up and up and up. You can't see any detail now. And eventually you get so high, you can see where there's trees, but you couldn't tell if it was a birch tree or an apple tree. It's just a tree. This is a very broad brush overview, big story view. In these slides, I'm going to try and pass on the knowledge of how to decide what you need. Please still take advice. Forming your company is not a DIY exercise. I've emphasized that a few times. I've had to keep fixing so many of these. It doesn't save any money. It actually costs money for you to do it yourself. Then get someone like me to fix it afterwards when you've gone down the path. You've made some you've made success of your business, but your business is not in the right direction. If you lower the helicopter, there have been nuances coming in. So please, I don't want anyone coming back and telling me, but yes, this is very broad brush I'm using right now. There will be some nuance in, and I'll deal with some of those in a moment. So therefore, in essence, I think there are simply 4 types of company, which I'll now explain. If you've listened this far, well done. I'm going to try and get your brain to work, please. So you're going to need to be involved in this one. So what sort of company do you need? I'm emphasizing this helicopter view. So what I'm going to do is I'm going to describe a company, and I'm going to describe it as to, in very broad terms, what it looks like. And I want you to think about what sort of property strategy do you think I'm talking about? Obviously, this is not interactive, so I'll pause for a moment. Hopefully your brain, some words pop into your head, and then you can compare your answers to mine. So let's kick off. And in this first company, you'll see here that I've said it's got a plus against the word assets. It's got a lot of assets. There's a lot of property in this. And hopefully the human isn't working too hard. So come on, folks, what sort of strategy do you think I'm talking about? I'll give you a moment to get some words popping into your head. And hopefully you might have said, look, it's my buy and hold strategy. It might be my HMOs, BTLs, my commercials. It is this utopian view we all seem to have that we want to have a passive income. Tell you now, I've been in property for decades. Passive is struggling. Commercial's the nearest I ever get to passive, and even that isn't passive. So it is your buy and hold. Now your second company. There we are. It is the reverse of the first. Now I refer to it as a service company. These are my words. You won't see the tax man using these words. This language is all for me. Now, this one doesn't have any assets in it, but the human's working ever so hard. So can you think of some strategies I might be talking about? Well, it's my do strategy. It might be rent to rent, Might be rent to SA, deal packaging, sourcing, letting management. Look at that phrase at the bottom. It could be your other company. It could be a firm of accountants. Could be your IT company, your manufacturing company. I seem to have a lot of my clients who are doing Amazon businesses. Well, that's great. It could be your other company where you're not exploiting an asset. You're instead working. It's almost like a job. The third one is a weirdo. This one's got a lot of assets in the company and there's a lot of effort, but that's only in there temporarily. Now you see the word I've used. I've used the word trade. I'm using that word in the sort of tradesman style. So you buy property, you work on it very hard, and then you dispose of the property. So what's the strategies? I think I've told you, haven't I? It's your buy and sell strategy. It might be a new build for sale. If you had a new build to hold, so build and hold, it would be in your investment company. But this is a new build to sell, your flips, for example. Now, I think any strategy you can come up with in property can fit somewhere within those three. You're either buying it to hold it, you're exploiting an asset, you're going to do something, it's your do strategy, or you're going to buy assets to sell them. Now, I did say there's going to be a fourth, so let me share with you my fourth. It's a holding company. Now, the holding company sits above and it just holds the other three together. The advantage of the holding company is that, let's imagine in this little picture here, you might be doing something in trade. You might be doing flips, and your logic of doing flips is you're going to make some chunks of profit, you hope. You'll pay your tax. There's nothing your accountant can do to stop you paying tax. He will just minimize it for you. And then what are you going to do with the profit? Maybe you take a little bit out for holidays, as Mark's always advising that. But the bulk of the cash, you want to send it over to your investment company. So what you can see there is the holding company is the bridge through which money moves between the trade company and the investment company, in my picture. Now, there is no tax on moving the money. You pay tax in the trade company, pay your 19%, but you don't pay tax to move your money from the trade company up to the holding company or the holding company down to the investment. So the holding company is there as a bridge. If you try to have that bridge as yourself, and we're moving money permanently through dividends or whatever, then there's income tax. Now, whilst I've got that page open, I want to talk about something called SPV. Now, don't know how many of you know what that means. Now, the usual words for that are a special purpose vehicle. Now, I think that sounds terribly exotic. Accountants were too boring for that. We don't do special. I'd like you to not use the word special. I'd love for you to use the word single. It's a single purpose vehicle. So what you can see on here, my investment company, all I'm doing on that investment company is I'm buying and holding. I'm exploiting my assets. I have a single purpose of buying and hold. Look at my trade company. I've got a single purpose. I buy, renovate, and sell. My holding company, I have a single purpose. It just holds my group together. Now, you've noticed I've skipped past service. So many people will have an investment strategy or a trade strategy, and they can make that an SPV. But frequently I find the situation where a person says, well, I want to dabble in a bit of rent to rent. I want to try it. Deal packaging and sourcing. Now, certainly you can go off and do this professionally, and if you're going to do it, please do it professionally. Get your money laundering regs sorted out with HMRC, etc. But it might well be that you're selling a deal quietly to a friend. I don't know. You're not meant to, but let's assume you have. What are you going to do? Well, you could just put that through your service company. So we have a situation with the client base that we have where if a client isn't aware totally of what they're going to do in their service company, they might do a few different things. We create what we call an incubator business. So we don't make it an SPV. We make it the complete opposite. We tell the world and we tell the taxman, this isn't an SPV. This has got a multiplicity of activities in it. Then if any one of the activities, so let's imagine you've done the three I've got on the screen, rent to rent, dual packaging, lettings, just imagine. And one of them gets to be very successful. Let's imagine it's your rent to rent. Let's imagine you've been following what Rick's been telling you and you've got your rent to rent working. Good. It's now smothering all these other small businesses that are living in the incubator. We'll move it out and you can give it its own service company, but don't create a service company for each type of activity just yet. It's too expensive. Keep forming companies and paying people like me. Okay, so what we're going to do now is we're going to lower the helicopter. So lowering the helicopter. We're going to start with that picture. That's the one we've just had. What other details? So as you've now coming down, you've lowered your helicopter, you're getting some more detail coming in. So your family could own the holding company. Now, I'm going to stop at that for a second. What do I mean by family? Well, it might be that inheritance and legacy is important to you. So rather than just the husband and wife owning this business, maybe we need to think about the family owning the holding company. Maybe the company could be a type of company. I don't have the time now to go into this with the webinar, but you could think about a family investment company, for example. So maybe the family owns it. It might well be that you have your commercial property in your personal names, not in a company. You could put them in the investment company, maybe you don't. Reason, I personally have some commercial properties in my own name. Reason for that is, I happen to be lucky, Section 24 does not apply to commercial property. If you're holding your commercial properties as a business, then you get business assets relief because I can pass it to my children under inheritance, which is why I did it. Okay, and to be quite honest, yeah, I like having some of the income so I can have the income in my pocket. Yes, I always try to manage my tax. I know I'm going to have to pay tax because I like having some money to spend. So therefore I take some of the profits from my commercial properties. So there's one. Now we're going to keep looking at this, and I'm now going to go over to the trade company. There we go. As you've lowered this down, I am not saying, please remember this is not professional advice. I am not saying that you will always put your flips in one company and your new builds in another, but it is quite conceivable that you might do so. So rather than having one trade company, you might have two. The reason for it, hopefully, will become a little bit evident to you in a moment. If you're involved in these, still the community infrastructure levy on flips probably doesn't apply, never has to me. If there's a lawyer present or an agent present, they might tell me otherwise, but fine, I've never had a SIL issue on my flips. On new builds, yeah, quite probably you're going to have to pay the community infrastructure levy. You might have to pay CITB, the Construction Industry Training Board levy. Might be applicable to both. You're certainly going to have to get involved in construction industry scheme on both, but here's the big one that's different. On your flips, it is a VAT exempt business. You cannot register for VAT, therefore the costs of the building works you've got to do cannot reclaim the VAT. Whereas on a new build, yes, it is VATable. You can register, you can get your VAT back. So it might be useful that you separate out your flips from your new builds, work out the maths. It's a spreadsheet answer, but work out the maths, work out whether it makes sense financially to separate it. Having just said that, let me take you back to GAAR. Do you remember right at the beginning of this presentation? If you take a step deliberately to avoid a tax, aren't you captured by GAAR? Haven't I just said that you would make a decision to avoid a tax? Yes, I have said that, but what GAAR gives you specific authority to do, it says that you cannot be guilty of an offence under GAAR, of tax evasion or tax abuse, by deciding how to trade your business. To make a decision as to whether to limited or whether to create a new limited because of a tax position does not create a GAAR risk. So for those of you that suddenly were thinking about tripping me up, I don't think I've tripped myself up here, folks. Okay, GAAR should not apply to this, or does not apply to this. Okay, so having talked about tripping myself up once, I'm going to risk it now. Please, no trolling. I do not need abusive emails or anything. Please bear in mind that on the slide you're about to see next, there is a question mark. We've looked at the service company, or maybe you're involved in the rent-to-rent business. So you've got your properties under rent-to-rent. Some of them are lease, some of them are management contracts. You've let all the properties out under AST. According to guidance, a rent-to-rent contract where you are taking your properties under lease will be exempt from VAT. You cannot register for VAT. There isn't a specific statement that taking your rent-to-rent properties under management agreement is VAT exempt. Hence the reason I've put the word VATable ? Please, no trolling, no abusive emails. I've never seen a case go before the tribunal where this was tested. As far as we are concerned, rent-to-rent under management agreement is VAT exempt as well. But part of the job of the accountant is to say, this one isn't a black and white, this one's got a shade of grey on it. Just be aware that there's some grey. So that's why I've put it onto that page, and hopefully it will help you to think through and reassure yourself as to what you think is right for you. So there is lowering the helicopter. I'm going to take my helicopter view back up. And I'm going to give you two possibilities here. I want you to think about these again. Take advice that's relevant to you, please. I know I keep saying it, I know it's boring, but please, it's really important. Maybe you want a really tight focus strategy. So I've got one of my clients, he's 70 something, I don't remember his age now, lovely man. And he's created something for his family, and he's created an investment company. Okay, that's it. He's got some investments, but he's got a problem. It's a nice problem to have, mind you, but he's got a problem. We want to keep the investment company as a single purpose vehicle. We just want to keep that for investments. We don't want to upset the mortgage companies by mixing in a bit of trade inside that investment company. So his problem is he's been out to look at 5 properties. And you might guess this is a made up story, this part, but the client is a true one. He's been out to look at 5 properties that he might buy. He's got enough money to buy one. He's got enough money for the deposit for one. These 5 properties are absolutely stonkingly brilliant. The maths are great. The geographics are great. Everything about it. He's done his deal stack. His deal stack is phenomenal. He can't find anything wrong. How does he pick which one to do? Well, the first thing he does, of course, is try to get some more money so he can do more than one. And lo and behold, he manages to find some money which he can borrow in. And he's got 2. Good. What do you do with the other 3? Do you just pick 2 and throw the other 3 in the bin? Well, of course, what he wanted to do, and quite rightly, was sell them. So it's a very small business. It's just simply something he's tucked underneath his investment company. So he didn't use a group company, he's just tucked it straight underneath his investment company. It's very small by comparison to the size of his investment company. He did tell the mortgage companies what he's doing, so he hasn't offended them. They were happy, and he's got a very tight focus strategy, and he'll have a little bit of service work. He's actually had a small consultancy fee as well. So his service company is just there ticking along, very small. So there's option. Let's have another look. Let's have a look at another option now. So option 2, this is my more flexible structure, and indeed it's the one I've just given you. It's where you keep things into their SPVs and their single purpose vehicles, maybe using your service company as an incubator. Looks simple though, doesn't it? You'll be pleased to hear you're at the last slide. Hopefully this is last but one slide. The last one has got my details on, but the last substantive slide. Hopefully this has been interesting to you. This next slide is actually one of my clients. Obviously no names. This chap is incredibly successful. I mean, seriously, this guy impresses me. But this is the structure he's ended up with his incredibly successful business. There it is. Wow. Let's start at the top. His family are the investors. If you look down underneath the family, got the word holding company. He has created that as an FIC, a family investment company. He takes some money in from family members who are interest free, so he takes that into his family and loans it down to his holding company. Some family members, however, have loaned money which are interest bearing, so he borrows that money straight at the holding company. You'll notice him initials there, CT61. If you're borrowing money in a company from a human, you have to complete a CT61 return when you pay them interest. If you don't, you get smacked. Get it right. That's why you need professional advice, people. You'll notice also to the side there, he's got his commercial portfolio in his own name. So I'm pleased with that because it looks like mine. So I was quite impressed he'd already done that. So underneath his holding company, you can see what he's got now. He's got an SPV, a single purpose vehicle for his personal investments. This is his BTLs and HMOs. He takes mortgages into that company. The next word across, you see I've got the word trade company. That's a cheat, actually, folks. The companies underneath, the flips and new builds, should actually be on that next line, but I just couldn't fit them in. So imagine them squeezed up onto that line. He does have an incubator for his ideas. He has indeed made a success out of the rent to rent, and he's moved it off into a separate company. He's got a JV partner, so he created a JV investment company. And what he's doing with the development company underneath the JV is he's making property developments there. He's converting. All that they do with that is they convert their profit in the development company are other properties, and therefore they pass the properties that they want to keep. So let's imagine he's built 10 houses, he sells 6 to pay back the bridge up, keeps 4, he moves them up to his investment company. There's no stamp duty to move them because he's going to keep them for more than 3 years. Again, take advice, folks. Once he's moved them in there, yes, he takes a mortgage on them, and he's getting mortgages on those, even though he's got the development company underneath, because the mortgage company is very aware that it's his own product that he's creating and keeping in his investment company. So there you have a particular client's structure, which he has allowed me to demonstrate with this graphic. Obviously, I haven't named him. And now that brings you to the end of my presentation. I hope you found value in it. I'm happy to chat with people. I do get overrun with people coming to ask me for free advice, and I love giving free advice. Unfortunately, too many of the people that ask me are they're asking me rather ridiculous questions, and they're rather basic. So I am going to change the words a bit now. So if people have a serious desire and a serious prospect to take their property business further, please feel free to contact me. You'll notice that I've created a new email address there for HMO. That's simply to let me know how many people have contacted me as a result of this webinar. I think that would be an interesting thing for me to know. Last thing, you can see my horrible caricature at the bottom on the left-hand side there, and obviously the company's logo on the right. Feel free to find us on Facebook. Like us if you want to. The company's obviously got a website. It's not been updated recently because I'm changing providers, but we tend to post an awful lot of useful information on there, which is part of your continuing education. So that's about me finished for this, folks. I hope that's been of value to you. And now I'm going to, hopefully Rick will come back online now.
Mark, that was amazing. Thank you so much. I mean, my head hurts when it comes to tax, and it's no better now because I don't get tax as well as a lot of people, and that's why we employ you to do it for us. So yes, thank you so much. It was a really informative presentation there. So folks, whilst this slide is up, what I want you to do is take a screenshot of the slide before we move forwards, because as you know, the summit is flowing, and if you miss it, you won't be able to get hold of Mark's details again. So please take a screenshot or write Mark's details down there. Going to give you a second to do that. And whilst everyone's doing that, Mark, I've just got a couple of questions. Now, they may be, low-level questions. I don't know. You kind of have covered some of them. But the first one is, when is the best time do you think to instruct an accountant? Is it right at the very beginning when people are just saying, well, you know what, I think I want to do this, or is it when they've got to maybe 2 or 3 houses already and they're starting to get some kind of momentum?
It's a fantastic question. Thank you so much, Rick. And it is a question that I have to address frequently for people. I'm afraid the answer, I'm sorry, folks, I think it's personal to the individual. Let me explain why. The person that comes to me and says, I'm thinking about buying a property this year, and then I've got to save my pennies up, I'm going to buy another one in 4 years' time. Do you think I need a company? Well, the best will in the world, folks, what do you think? Do you really imagine having a company to pay for accountants and all that other good stuff for 4 years? So that person, actually, just get on with it. Put it in your own name. Tax returns aren't that difficult if you've just got a single property. It's fine. You don't really need my skills. Okay. Imagine, however, the person that comes to me and says, I'm going to buy 2 this month, and then I'm going to buy another 2 in a couple of months' time. I've got a JV partner and he's going to jump on board as well. In other words, there's going to be some forward momentum on a decent rate. The problem that second person will have is if they don't get it right soon, they will have gone powerfully down potentially the wrong road. So the first one might have gently gone down the wrong road and we can just gently pull them back. The first one would have gone powerfully down the wrong road. Much better that they took advice right on day one. So I'm afraid it does depend upon the individual personal circumstances. What are your aspirations? Where are you going to try and take your business to, and when?
Okay, and a lot of these are going to be quite open questions, and and it's very in property and in training, and it really does depend, doesn't it? And that's what we say when people say they come on the Facebook groups, and don't get me wrong, I'm an advocate of Facebook groups. I love them. That's why we've got one. But you do have to take your own advice, everyone. You've got to do your own due diligence, because people love to help people, but sometimes it might be just a little bit misplaced. Mark, do people often come to you when you perhaps think it's perhaps a little bit too late? Is it ever too late?
Oh, yes. Yes. The person that comes to you, I really have a problem with people at DIY. So even if people don't want to come to us, go to somebody. If you're going to be a property entrepreneur rather than just perhaps have an odd investment here or there, if you're going to be a property entrepreneur, take some advice. There are lots of good property accountants out there. Unfortunately, there's some that aren't quite as good, but there's some good property accountants out there. Go and find one that fits you. If things feel as if they're not going right, and if the advice you're listening to, if things feel as if it's not, if it sounds wrong, it feels wrong, guess what? It's probably wrong. And sometimes you can go so powerfully down the wrong path that actually it's quite expensive to come backwards now. I think it's also important that people keep a focus back on this sort of moral and ethical standards of the advisors. Just make sure that they fit you, so that you will always be happy to take your personal responsibility for the decisions you've made in your business. But sometimes people do go a long way down the path, and therefore it's quite expensive to get them back onto the right path.
And you mentioned, as long as you do take advice. Now, can people go to a normal practice accountant for their property business?
No. Sorry. Again, let's imagine you've just got one property, etc. I'll recount a story from today. Someone's phoned, they've shared the advice, and they shared the advice because they already know. You wouldn't have shared the advice you've had from your accountant with someone like me because you thought it was perfect. You just wouldn't have bothered. So once you know and feel that it's wrong, then you know it's wrong. So I think property is a very specialized area of business, and I think you really need property accountants.
Yeah, I fully agree. It's a big business. Let's set it up right, folks. Let's do it right from the start. Start with the end in mind and be completely transparent. And if you can do all of that, then you're on a good head start above everybody else. So Again, folks, Mark's details are there. Please grab hold of them now. Mark, I suspect you're going to get quite a lot of calls and emails from the back of your presentation. It was absolutely fantastic. Thank you so much for spending your afternoon with us on the Property Summit. And hopefully you get loads and loads of calls and emails. So folks, screenshot this now before it disappears in the next 10 seconds. Mark, thanks for joining us.
Rick, it's been a pleasure and well done for putting this on.
Thank you.